Hello, we are so happy to have you with us today. We're waiting to give everyone a chance to sign into the room. Thank you for joining the Schultze Asset Management Investor Webinar for the third quarter of this year. We're so happy to see you and provide updates to our firm and our fund. I am Angela Louie, Head of Business Development at Schultze Asset Management. Today, we will talk about where presently to find investment opportunities, and here to speak on that is George Schultze, founder and managing member at Schultze Asset Management. We will also delve a bit into some aspects of the firm management, and I am pleased to introduce Jeffrey Glick, the CFO of the firm, to speak on that. This webinar is for investors only. If you are press or media, please sign off now and contact us directly at investorrelations@samco.net. Please give me just a minute for me to share my presentation on the screen with all of you. This presentation summarizes our views. For a more detailed and expanded description of our view, I highly encourage you to read our latest quarterly report that has just been sent to you right before we started this webinar. Well, we have an hour together, and in that hour, we will cover a market review of our last quarter and the outlook for the end of 2021. Let's explore this question. Where are our year-to-date gains coming from, and where are profitable opportunities for the balance of the year? George will speak to trends that are dominating the markets, performance attribution for the fund, and directly respond to one very pressing question. With default rates so low, where are our returns being generated from? George will talk about our unique investment strategy and how we utilize risk management. And by using 4 trade examples from our portfolio, we will illustrate how we view opportunities in both the public and private markets. Jeffrey Glick will talk about our returns, our business operations, and our relationships with our service providers. And we'll leave you with some key takeaways for what to expect going forward. There will be a brief Q&A at the end of this presentation, so please type your questions at any time during the presentation, and we will do our very best to get to them. So let's begin. This year, up until the third quarter, our fund has gained 30.5% net, beating broad market indices. Russell, in turn, has gained 2.5%, and the S&P 500 has gained 14.7% for the same period. We've had a good year so far, and for those who are keeping score, our fund gained 32% net for those keeping score. Last year, we've been up 28% as well. We took losses in post-distress warrants, and we took some profits in post-distress equities. Those who know us will know our focus. We look for unconventional ideas to drive our returns. They are event-driven in nature, and with these types of catalysts, they are generally uncorrelated to the markets. We embed hedges into our portfolio to protect against market inflation and the ever-heightening inflation risk. And we manage risk by adhering to our process, utilizing strong fundamental analysis, limited leverage, appropriate position sizing, and stop losses. Default rates are low, which may worry other distressed securities investment managers, but not us. And George will tell you why in a moment. We announced the IPO of our second SPAC. Our long portfolio is cheap at 4.25 times enterprise value. This compares with S&P's multiple at 13.93 times. And we're celebrating our 23rd year of managing money for our investors. And we are so happy to be able to see you virtually today. Let's talk about what's been happening this past quarter and what's going on this current quarter. Bottom up, I will start rattling off some numbers. Real GDP growth at 2%, unemployment at 4.8%, inflation at 5.4%, and Fed funds rate at 0.3%. So what do we make of that? In summary, monetary and fiscal policies remain very expansionary. Rates remain close to zero, driving up inflation fear. We might all recall the taper tantrum of 2013, and it is a non-zero probability that we will go through that again. In addition, various acts passed, as well as the stimulus checks and the $1 trillion infrastructure plan, means that there is a lot of money sloshing around. So what does that mean for us at Schultz Asset Management? Well, all of this means for our strategy is that there has been a shift in focus for us to look at post-distress firms that have recently been reorganized. Portfolio hedges remain crucial to our portfolio construction, and we are smartly utilizing conviction-based shorts on companies facing Chapter 11. This is a good spot for me to stop. George Schultz, founder of the firm and managing member, will now talk more in details on what is going on in the portfolio. And just a brief background on George. He chairs our investment and strategy committees. He wrote the book, The Art of Vulture Investing, which I encourage you to check out if you haven't read it already. And before founding this firm, he worked at MD SAS, Fiduciary Partners, which is a fund-to-fund, Mayer Brown and Platt law firm, and Merrill Lynch. Quick reminder for everyone, if you have any questions, please type it into our Q&A box at any time, and we will do our very best to get to them at the end of our presentation. Hi, George.
Hi, Angela. Thank you. And thank you, ladies and gentlemen, for dialing in today. Well, let's get right into it. What's going on in the default world and distressed investing in general? So defaults have dropped tremendously, as you can see here. Due to massive fiscal and monetary stimulus, you've seen them plunge down to near record low levels in the third quarter, and they've stayed there since the end of the third quarter. You can see, looking back here on this chart, which comes from JP Morgan, going back to 1994, numerous default cycles, and you see some cyclicality in this industry overall. You're looking at the visual of high yield bond only defaults, and you can see that every 5 to 10 years you see a spike in defaults and a subsequent drop off, and sometimes just hovering around with low defaults. So again, they've dropped because of the massive fiscal and monetary stimulus Angela just mentioned. Right now they're just under 1%, which is well below the long-term average, which is closer to 3.5%. The total number of companies is relatively modest, under 10 billion versus almost 125 billion year to date last year. I think an important takeaway, though, from this chart is really that this sector, distressed securities investing, does not need to be so cyclical. What we've done with our fund and our firm over the years, we've tried to develop a three-pronged approach for investing in the space. And the idea is to take the cyclicality out of it. So when default rates are high, as you can imagine, that's typically the time when there's the most amount of distressed debt outstanding. And usually it makes sense to be invested long in distressed debt when default rates spike. However, when they drop, usually that's the best time to focus on companies that were previously distressed and restructured through a bankruptcy court restructuring, or maybe outside of bankruptcy court. Also, when default rates drop, the capital markets tend to be, relatively open. As Angela said, there's, cash sloshing around. Capital markets are open, for fixed income and equity issuance. And with that, often those lower default environments represent not just good times for buying distressed or post-distress equities, but also for finding those that might have event-driven catalysts because their balance sheets are clean after their restructuring. There's often a great opportunity to use some leverage to finance things like stock buybacks, special dividends, or even M&A transactions. And by the way, post-distress equity investing doesn't need to focus just on the public domain. There's also a great opportunity in private post-distress equities via either private equity or also through SPACs. And that's why we've opened up our SPAC specialty as well a couple of years ago. And we'll talk about that a little bit more in a few moments. Let's move on to distress trends across different industries. Every quarter, our longstanding clients will recognize this chart. We update it every quarter with the newest and latest trends are. What you can see here is with almost every industry, you're seeing a massive recovery from post-COVID. You see lots of post-distress equities virtually in every industry. But a couple interesting takeaways beyond that. Of course, in the real estate space, 3/4 of the way down, you had the China construction bubble, and now you're starting to see big defaults in China with Evergrande and Kaisa and other companies there like Sunac. The question with Chinese real estate is whether that's going to be an isolated event or whether that problem might become so big that it could present systemic trouble to the worldwide markets. And we're a little bit still on the fence on that question, but it's certainly a developing situation and one worth monitoring. We'll see how it all plays out because the tight new real estate policies, the 3 red lines policies that the government of China has issued, we think they might push back a little bit on that to try to give the real estate developers there that are all seeing such a massive drop in sales and financial stress, to give them some more liquidity. We think there might be some political accommodation there going forward. But just a couple words about a few other sectors here. Airlines, of course, during COVID, we saw Boeing nearly went bankrupt and it's recovered since then. In the auto manufacturing space, we actually have 2 positions in our fund, both General Motors, which has performed quite well. There's more detail about that in the quarterly letter, as well as Stellantis, which is the newly named post-merger between Fiat and PSG Group, a major auto supplier that has roots dating back all the way to Chrysler's bankruptcy from a few years ago. In the casino space, of course, you have Caesars, which back when it went through bankruptcy was the largest casino bankruptcy ever. Since then, it nearly went into bankruptcy again in the middle of COVID, right after merging with El Dorado Resorts. Excuse me. And that business has evolved a lot since then. It's actually transformed quite nicely after restructuring its balance sheet and also starting to invest heavily into online gambling. In the coal space, we'll talk about Alpha Metallurgical Coal today in a few minutes. In the energy space, lots of activity in energy, E&P companies. We'll talk about Chesapeake Energy today as one example. Moving along the list, financial services, not too much distress there these days, but lots of companies that were formerly distressed still present interesting value plays. For instance, Bank of America, which is a long-standing holding in our fund. And these big banks, they're increasing their net interest income. They're hoping for higher interest rates going forward. reversing reserves they took during COVID, and they're benefiting from the low default environment we're seeing right now. On the government side, it's all about Puerto Rico right now. That's the largest municipal bankruptcy ever, and its general obligation bonds are winding their way through bankruptcy right now. The confirmation hearing for Puerto Rico started this week, and there's some interesting ways to play that, including through MBIA stock. A couple more points on this page. Litigation. I think probably the busiest thing happening right now with litigation and bankruptcy is opioid bankruptcies. Right now you have a company called Mallinckrodt that's in bankruptcy due to opioid production. And it's also going through confirmation proceedings. Also recently, Johnson & Johnson filed for bankruptcy their talc business due to mass torts and liabilities related to that. We'll see how that plays out. I make one last point on this page. I mean, there's a lot to talk about when you list all these different industries, and it's really a sign of all that's going on in distressed securities investing right now, even though default rates are low. But on the utility side, the last bullet here on this page, there are a number of post-distress equities that look very interesting. For instance, Vistra, which is a position or a fund. That company is the utility in Texas, the largest utility in Texas, has roots going back to a major bankruptcy from just a couple of years ago, TXU, and then Pacific Gas and Electric, of course, which restructured last year as well, and saw lots of problems with extreme fire, wildfires, and extreme weather. So again, the takeaway is that there's lots going on across many different sectors right now, and probably the best way to play all of these themes is with post-distress equities. So, Angela already gave you a highlight, but basically so far this year, we've trounced the broad equity indices, which are up about 2.5% and 14.7% so far through the year. This trend continued past quarter's end, so we're excited about that. Just regarding attribution, and you see the chart here on the right. There's more detail about this in our quarterly letter, but we're happy with our win-loss ratio this quarter, especially on the short book, where we had a 55 times win-loss ratio. The main driver there was GTT, where we short sold their pre-distressed stock and recovered the position after the bankruptcy filing. On the other hand, post-distress warrants underperformed. The main driver there was our Cleverleaves post-SPAC merger warrants, and we'll talk about that position in a few minutes as well. One interesting takeaway as well here in the attribution box on the right, and this shows the percentage of our portfolio in different types of positions. You can see post-distress equities are more than 100% of the book. That means there's slight margin borrowing. Distressed bonds are about 4%, post-distress warrants about 8%, short stocks about -2%, and ETFs, which are hedges, about -3%. But an interesting takeaway here is what happened with post-distress equities on the realized gains and losses column. So we took some profits with a couple positions, both Alpha Metallurgical and Chesapeake Energy, even though we think both are still extraordinarily cheap. We took some profits as they really generated great returns and became a little bit overweighted in the fund. Fortunately, this is also a tax efficient result because I think most investors expect, at least in the US, that taxes will be going up from their low rates where they currently are. You've seen the infrastructure bill pass. We don't know, if the next spending bill in the US will pass as well, but it's pretty certain that that tax rates will likely go up from here. So taking some gains this year is most likely the right thing to do in terms of tax efficiency as well. Let's talk about Alpha Met. So strong return in the quarter, 94% IRR. This is a Tennessee-based met coal miner. It has 18 coal mines and 8 coal preparation plants with 14 million tons of capacity. When they restructured, they eliminated almost $8 billion of debt. And for those of you who don't know, met coal is a critical feedstock for making steel. It's not the coal that's burned to generate electricity, which is becoming more and more out of favor and being replaced by natural gas and other ESG-friendly alternatives. But met coal just isn't going anywhere. The global economy needs steel, and Alpha Metallurgical is one of the main producers. It's become a pure play producer. It's the largest met coal producer in the United States. And after restructured, eliminating all that debt, the $8 billion in debt, it doesn't just have a clean balance sheet, but it was also able to preserve substantial tax assets, nearly $2 billion of NOLs, which should help it avoid having to pay future cash income taxes for many years. Most analysts expect met coal prices to continue rallying. You're seeing a good recovery globally, which means increasing demand for steel. And in the US now, of course, you've also had a new infrastructure bill, which was just passed, which will continue to support that theme even more. During the last quarter, AMR management succeeded in reducing remaining long-term debt and legacy liabilities by over 75 million. And despite this, as well as favorable financial guidance they released for 2022, the stock remains incredibly cheap at only 1.55 times total enterprise value to EBITDA for next year. It's currently trading at about $55 a share. Our target is over 80, which would mean an additional more than 45% appreciation from here. So we're excited about this position. It's doing well, and it also is a good way to play the continuing theme of inflation in the economy. So I mentioned Chesapeake earlier. This is a major E&P firm in the United States that's exploration and production. It's focused on natural gas and came through bankruptcy, emerged in February of this year. It too eliminated about $8 billion in debt through bankruptcy restructuring. It was a highly contested plan, but the senior lenders got the bulk of the equity here. And since then, the company has really started to generate outstanding cash flow. With that, they've become very shareholder friendly post emergence. The new ticker is CHK. It's listed on NASDAQ. But one of their first moves, the management's first moves post bankruptcy, was to start a new $37.5 per share dividend as initial base dividend. Then afterwards, during the quarter, they announced this transformative acquisition to acquire a company called Vine Energy, which is really just their next door neighbor in the Haynesville Basin. And I'm not sure if any investors on the call know much about the Haynesville location, but it's a critical exporting region in the United States for exporting natural gas to the LNG market, where pricing is very favorable right now. So this was a good bolt-on acquisition. Management expects 50 million in synergies. They paid a zero premium to buy the business. I guess I would have liked to have had seen them pay a little bit more equity and I'm sorry, more cash, less equity. They paid 8% cash and 92% equity. But either way, the company pro forma has a very strong balance sheet. And with that, on closing, they also announced, and it is closed now, the transaction. First, they increased their annualized dividend by almost 30% to $1.75 a share. And more importantly, they announced a new variable dividend where 50% of all quarterly free cash flow going forward will be paid out as a dividend to shareholders. So that's an incredible yield. The company's cash flow is growing substantially as natural gas prices keep rallying here. And even so, I mean, the stock generated good returns during the quarter. They started their dividend, but even so, it's extraordinarily cheap at only 3.13 times EBITDA. It's currently trading at just under $66 a share, $65.95, and our target is $95 a share or more with the dividend. So that would be an additional 45% bump up from where it's currently trading. So Clever Leaves we had some losses on this position during the quarter. They are unrealized. We think the stock is temporarily down, really with no news. By the way, the position, we are still restricted in this position. There's a lockup which lasts about a year after the merger with our first SPAC. But still, even being down temporarily for the quarter, we still have a very large gain in this position because we have such low costs from merging it with our SPAC. This company, is strategically very important. It's one of the lowest cost operators or producers of medical cannabis by a factor of, we estimate, about 10 times. Recently, they've entered into numerous partnerships, not just with the Colombian government where they're based and where they produce, but also with a Brazilian partner, with a company called PHL Labs in Colombia, as well as a German partnership. And we expect to hear more about those partnerships, which should really increase their growth and increase their top line realization story later today when they report their earnings. Not sure if people know this, but they have the majority of the Colombian export quota for cannabis, and if that was to be fully taken up, it would represent about 18% of the world's total market share. So strategically, it's a very important asset. We like it. We think it's temporarily down here at current levels, and that there's a great opportunity for future gains with Clever Leaves. Anyway, with the success that we had with SPAC number one, proud to report that shortly after quarter's end, we closed on the IPO of our second SPAC, Schulte Special Purpose Acquisition Corp. 2, listed on NASDAQ. In total, we raised just under $170 million for this new entity, and we're looking forward to finding the next excellent business to merge with this second SPAC of ours. We have upgraded our underwriter team with both Stifel and Mizuho. And Stifel, I'm sure most investors on the call are familiar with these two investment banks, but Stifel was also a minority investor in our sponsor Seed Capital for this second SPAC. Oh, sorry, if you could just go back, please. Yeah, thanks. A couple other things with the second SPAC, we've enhanced our team by adding 5 new advisory board members with special industry experience, which we think will help with the M&A process for sourcing and diligencing targets. And then just the same way that we did with SPAC number one, because really the only way to think of this investment is it's like private equity. It'll take a while to realize, but it should have, if we execute well, we should have great gains on it. But it is side pocketed in our fund with a new side pocket. We call it side pocket number 7, just like the first SPAC was side pocket number 6 in our fund. So excited about this. You can see here the photo of the NASDAQ listing at Times Square in New York City on the day of the listing, and looking forward to reporting more about that public company as we go forward. So I gave you a preview about GTT, strong gain, excuse me, short selling their stock during the quarter. Pardon me. So by way of background, this is a telecommunications firm. It's a managed service provider. The remaining business, it was just split up pre-bankruptcy, but the remaining business is a managed service provider, which provides cloud networking services to large and multinational clients. It has a global tier 1 IP network that operates and provides services in over 140 countries through 600 points of presence. And the business was really built through acquisitions. The last few really added a lot of debt and ultimately caused them distress. They also had some managerial turnover. They had some difficulty filing their SEC reports on time, and they had a default. So we were short, our fund was short the stock, and we covered it during the quarter, realizing strong gains. This is one of our top positions during the quarter. And by the way, this is the third trade. I forgot to mention this earlier when we were looking at the default slide. And the point of it is really that to take away the cyclicality of the distressed market, as default rates are rising, usually that's the best time to find companies like this that you can short sell as they get into trouble. And that's exactly what we did with GTT. We focus on short selling their equities because in the US, when companies go bankrupt, shareholders almost never receive anything, as you could expect. But it's a bit of an inefficient market because most other distressed securities funds don't play in this part of that cycle. So anyway, fast forward to today. We've covered the short. The company filed its prepackaged Chapter 11 plan. It entered into a restructuring support agreement with its primary lenders to reduce debt by about $3 billion. The plan will split the NewCo's equity 88% to senior lenders and 12% to bondholders. And the company is also selling and has already closed on the sale of its former infrastructure unit business. And cash proceeds from that sale were used to reduce the senior lender claims. So when the dust settles, senior lenders will also get excess cash that was held back in escrow from that transaction, as well as a new $854 million exit term loan. And bondholders, besides getting 12% of the equity, they'll also get 5-year warrants and rights to buy additional shares. So, we do have a new small position in the distressed bonds for this company. They're currently trading at about 11 cents on the dollar, which at that price, that would imply a new enterprise value to EBITDA multiple for GTT NewCo when it emerges from bankruptcy, which we expect relatively near term, of about 5.25 times EBITDA, which we think is a big discount to fair value of about 8 to 10 times EBITDA for these types of businesses. So we're excited about that. Look forward to updating you on that. And with that, let me pass the baton back to Angela, and I'll be available for Q&A as well. So thanks again, folks.
Thank you, George. We will talk about our year-to-date returns in our next couple of slides. For the quarter, our fund was down 1% net, while the Russell 2000 was down 12.4%, and the S&P 500 was up 20 basis points. Strong gains came from the short sold stocks, offset by losses in post-distress warrants. We took profits in the long post-distress equities and realized some of the gains in these appreciated positions. In spite of all of this, our portfolio still remains cheap. And this is a very good spot for me to introduce Jeff. I'd like to remind everyone that if you have any questions, please type them into our Q&A box at any time, and we will do our best to try to get to them at the end of the presentation. So here to talk about our returns and the operations of our business is our CFO, Jeffrey Glick.
Hello, everybody, and thanks for spending time with us. I've been at Schulte for over 5 years now, and I'm very proud of the advances we've made in the last couple of years. As you know, Schulte Asset Management has been in business for over 25 years now, and they've had life-to-date investments of about $7.4 billion. The current AUM is about $240 million, and we're very proud to be the caretaker and partner with you. Because we've been investing for so many years, we've invested through many cycles over the last quarter of a century. And we have developed procedures, processes to maintain that and to maintain the loyalty of our LPs. As stated prior, the September returns year to date is 30.5%. Last year was 28%. And through 9/30/21, the Russell was up 2.5% and the S&P was 14.7%. October looks to be another good month with about a 5% increase. Now, as a CFO, I strive always to improve operationally what we're doing here. And that includes, among other things, that we have weekly calls with our administrator, UMB. Schulte Asset Management and UMB are a team, and we take that relationship to heart. The advantage of speaking every week is that we all know what's going on with the position and our investors. And the same thing with our auditors, RSM. We have at least quarterly updates, if not more, with them just so they understand what's going on in our fund. And the other important thing is having a great relationship with our administrator. Is we improve everything that we do. They're already experts in our type of investing, but because we allow them to see what we're doing, it also creates a trust, and it also makes it easier for them to do the timely reporting, because on a monthly basis, there are no surprises. Another important aspect of our controls and just our operation improvement is our weekly portfolio meetings. We have people from the investment side, operation side, legal side, always involved in our investments. And that creates a lot of trust, and everything is fully vetted before it goes into our portfolio. From a operation side, we're very happy with our service providers. We only pick excellent service providers. And, if you look at our list, we have S Castle for IT, UMB for our administrator, RSM as our auditors, and we have a great staff of legal advisors. That's about it on my side, Angela.
Thank you, Jeff. Thank you, George. Let's take some time now to answer some of your questions. I've brought George and Jeff back on. Again, we're very grateful for everyone's time today, so we're going to get straight to the questions. This one is for George. The question is, why can't investors just go into the public market and get SPAC exposure? We see SPAC indices being launched, so why not just go direct there versus going through Schultz Asset Management's fund?
Okay, good question. Thanks, Angela. Not sure who asked it, but thank you for the question. So it is possible. You can invest directly in SPACs. You can invest directly, on the public market, also through SPAC indices. What you get with our fund, though, is a little bit of a more concentrated approach. You're not investing in the shares that trade publicly by investing in our fund. What you're getting is, an investment in the founder's equity, so the sponsor equity, and that's different. That's not available publicly. It's the turbocharged equity that comes with the sponsor. Decides to launch a SPAC and really provides for. There is risk with it. There's risk of 100% loss, but there's also potential for 4 to 6 times return on your invested capital for these investments, because the sponsor capital provides the initial seed capital for a SPAC that pays for the underwriting, pays for the legal fees of the SEC registration process when you initially do an IPO for a blank check SPAC company. But then in exchange for taking that risk, and again, the risk is 100% loss if you don't find a suitable merger candidate. But the upside is that, if you do, and every deal is subject to negotiation, of course, but if you find a suitable merger candidate, that sponsor capital is eligible to get up to 20% of the combined public company's stock. And so that's where you get the real sort of juice with the SPAC seed capital. And we don't know of another opportunity to buy that directly on the public markets.
So it sounds like you're describing a very different time in the life cycle of the launch, the IPO, and then to SPACing. So that's very helpful.
And it also, just to put a little bit more meat on the bones with it, I don't know if you can still bring up the slide, with our returns, but you can see, for instance, when we de-SPACed last year, if you have the Schultz Partners returns, you can see, a big gain in December of 2020, which you couldn't have gotten in the SPAC market directly. But that's when our SPAC merged. You can see the nearly 54% gain in 1 month there. That's when our SPAC merged with with its business combination. As a sidebar, this is also a phenomenal tool for companies that were previously distressed because it helps get them, if they're private, back into the public market, and also gives them the potential to benefit from cash that's sitting on the SPAC's balance sheet as well through the trust account. And with that, what's surprising to me is that there aren't more, post-distress focused SPACs like ours, because it's a perfect tool for bringing these companies back to the public market, after not just distress, but after they became private through distress transaction of some sort.
This is a good kind of segue for the next question, which is, George, what's going on with Cleverleaves?
Yeah, so we'll hear a little bit more about it later on today when the company reports earnings. We're public market investors in that. There's one person here, Gary Julian, who's not on this call. He's on the board of the company. But we are public market investors in it, and we're waiting to see how the results look today. I would anticipate that they'll have some more details about their current partnerships that they've recently struck, and maybe give some more guidance. We'll see. But I think, as I said earlier, Cleverleaves remains a very important strategic asset as one of the lowest cost producers of pharmaceutical grade medical cannabis globally. And I think that sector, although cannabis has gone through fits and starts with political interest and lack of political interest here and there, even though you've seen some volatility in the stock, I would advise people that the long-term opportunity remains there, and the growth that will come from that sector eventually, not just in other markets, but also eventually into the U.S., I think is one that's worth betting on.
Jeff, this one's for you. This past year and a half has been difficult for everyone. Besides being an expert in Zoom now, and maybe even like learning how to unmute yourself when it's our turn to speak, what are some lessons that you've learned during this incredible time?
The first thing we learned was the investment we made in technology has paid off. For years, you always heard a disaster recovery, business continuity, and it seemed almost like a black hole because it was best practices. The investors wanted it, and it's just good business practice. In the last 18 months, 20 months, if you didn't have good disaster recovery, business continuity planning, you were in trouble, especially for an industry that relies so heavily on technology. We all have Wi-Fi at the homes, high speed. We made sure of it. We all have up-to-date laptops that can handle Zoom, that can handle all of the heavy burdened applications that we all use. And that also goes down to our service providers. We ask continually about disaster recovery, et cetera, because everybody else had the same issue. And we were, I wouldn't say lucky, we were fortunate that we spent the time prior to COVID to make sure that from top to bottom, we knew that we could rely on our service providers. It's hard to think that we went through 2 year-end audit cycles already with COVID. We went through almost a year of the SPAC, the first SPAC with COVID, and we were able to keep it going and maintain our excellence and maintain the relationship with our LPs, and that's where it all boils down to.
That's very insightful. Also, if I may just add a little bit to what I'm observing in your work with the relationships externally and even internally, it also looks like because of this shift, there has been increase in frequency of checking in with vendors with internal kind of internal status reports, internal updates, just out of precaution to make sure that nothing slips through the cracks. And it sounds almost like this trend of being efficient in the usage of our time to constantly connect with each other is here to stay.
Yeah, for sure. And, our conversations have switched. We always spoke about the portfolio and the issues with our administrator, but as COVID really started to hit hard, and we determined it's going to be a long, drawn out affair, working from home, we made sure that our administrators and partners and service providers all had adequate resources and bandwidth to handle our needs, because we weren't the only ones who needed this, and we didn't want to shortchange ourselves or our LPs.
Thank you, Jeff. And how about you, George? What have you learned so far from navigating this time and protecting returns? One of the big elephant in the room is that while managers across strategies, not just distressed, are still finding their footing to sort of adjust in this new environment. On the other side of all of this, the 30 plus 30% returns this year and last year, that 28%, plus the fact that most recently we were named the best event-driven hedge fund for 2021 by HedgeWeek. Well, that's something that is extraordinary. So I want to ask, what has been the lessons that you've learned from going through this period?
Good question, Angela. I would say, the ability to remain nimble, and also, it is very much a team approach here. Jeff mentioned the weekly investment committee meetings. I think those are extremely valuable. We also have some great new members. Kyle Montello, who joined us coming out of Tulane Law School and Business School. Brian Donovan, who's of course supporting you. This Iona MBA. And the rest of the staff. I mean, we just have phenomenal staff, and the team approach to not just finding ideas, but executing on them, coming to consensus in those investment committee meetings. It's also, I guess it's easy to find ideas, but presenting them in the same format and getting the whole team to buy into them, just that going through that process, I think is helpful, and it really helps you maintain the discipline of carefully investing, capital that you manage as a fiduciary for others. I would say also just, going back to the theme of, being nimble and being flexible, lots of things changed during COVID, and, you've seen it with things like the meme stock phenomenon where, some companies, even though they look terrible, can rally overnight. And I think, having good, well thought out risk controls in the portfolio, whether it's limited use of leverage or lack of derivatives, or moderate position sizing, and growing positions slowly over time, and the all important high watermark rule, which is the toughest to abide by, but I think also the most important for managing risk on the downside. I think having an institutional process in place, for the portfolio, with things like that in it, and the team approach in general, I think gives you an edge during changing times like we saw with COVID. Mm-hmm. And of course, like any changing marketplace, COVID also brought, just tremendous distress across all these different sectors. And so there were some great opportunities to put capital to work in the middle of it. I think going forward, as I said earlier, you may start to see similar systemic things occurring as the Chinese real estate market bubble collapses. We shall see. I mean, there's a lot of leverage out there right now. But this might all be the starting point for the next, distress cycle as interest rates start to climb here inevitably, because, inflation is there. We see just, this morning that the CPI now is running at 6.2%. I think, these figures are going to potentially force the hand of the Fed to raise interest rates, and higher rates plus, distress coming out of Asia, and the all important, construction sector in China, which was the world's economic growth basket, could be some of the early parts of the next distress cycle. We'll see. But if it is, I think that's when we pivot and start short selling things more, and the portfolio will evolve with that going forward.
I'm really glad you brought up Evergrande, because it's super interesting. It's dominating headlines in many circles, and one of the things you brought up is we've got a good bench of people, especially on the investment side, monitoring situations. And my my question for you then is, with these fast developing headlines to it and reports to it, how do you view the contagion risk being posed by Evergrande and even some similar real estate companies in China right now?
Good question. I mean, I think nobody can know for sure, obviously, but many people were talking about this just a couple of weeks ago as the whether Evergrande might be the Lehman moment that China is experiencing now, 10 years after we went through it with Lehman. And the answer is, it doesn't look like it is yet, even though it's just sort of officially defaulted today, and it looks like it'll be going through bankruptcy. It doesn't seem to be happening yet. And so, I do take some comfort in the fact that, the Chinese government, is very proactive, and it may step in if something like that starts to develop as a real systemic risk. I think there are a lot of interesting parallels, but there are a lot of contrasts also between what happened with Lehman Brothers. With Lehman Brothers, it was one of many banks that were failing in the United States, because the real estate market had gotten so hot with with derivative-driven borrowing. Think CDOs and CDO squareds and subprime loans and derivatives that traded on those. And so you had numerous banks that were insolvent in the US. Most banks actually were insolvent in the US, and they were all over levered. Well, this time around, things look different, at least from the US side. The banks are all quite stable. They have lots of liquidity. Their balance sheets are pretty clean. One of them, which is in our portfolio, actually, Bank of America, it looks excellent. Same with Citigroup. They've cleaned up their act. They're well past that crisis. And so, it doesn't seem to me that you'll see the same kind of systemic risk from that, at least into the US markets, at least not for now. But you may see a slowdown in the economy as a result. I think all economies these days are interconnected in some way or another, but China is obviously more interconnected with the rest of the world than other economies. So we shall see. In terms of specific systemic risks to Chinese lenders, I guess we won't know for sure until we know. They all say they're not, though. So we'll have to take their word for it for now.
Yeah. Jeff, investors get their reports pretty timely. They know what to expect. They know, every year it's a pretty smooth process of them receiving reports. But I know from just observing you that it is not without a lot of work. So one of the questions is, how do you and the fund administrator, UMB, specifically manage issues that surface throughout the month?
Well, most important thing is that we talk about it. We have, very good controls on what we do. We have a middle back office provider that reconciles our cash and our positions every day to our prime broker and to our books and records. So the positions are always reconciled. The cash is always reconciled every day. If there's a broken trade or something doesn't agree, that's looked at either overnight or first thing in the morning. So we always trade on a position that's accurate. So that's the worst thing, is to trade on an inaccurate position. So if that doesn't get reconciled or fixed right away, then it goes on the next level. And then I get involved and make a couple of phone calls and emails and say, what's going on? How come it didn't agree? And typically it could be that we use an away broker and there was a breakdown or something, and we straighten it out. In terms of transactions, we're not, as George said, we're not the usual fund. We do public securities and private securities. And UMB has excellent resources, excellent experience, but all these private deals are different. You know, if you're investing up and down the capital structure, every layer in the leverage of a company is different, and each one has different rules, et cetera, et cetera. And so we share all our documents with our administrator, and we go through the proper way how to book it, or they tell us the proper way how to book it. And I mean, we're in agreement. They use best practices. And, you know, and at the end of the year, when we go to audit, and if those transactions get pulled, we don't have any issues. So we have a high reliance on our communication and teamwork with UMB before, during, and after, and throughout the whole year.
Yeah, it sounds like a highly collaborative approach. Our last question is for George, and it is that, generally speaking, complexities is something we all fear. I mean, just like life philosophy, professional life, personal life, we all fear that. How does the complexities within restructuring and being tied up for some time play into your investment process and also into your research process?
Good question. Actually, I like complexity. I think, you know, the more complex, the better for me. That's my personal feeling. Maybe not, you know, in personal life, and certainly not in business operations. More, you know, it's opposite in those. But you know, complexity in an investment actually helps us find inefficiently priced securities. And the best way I think I can explain that is by thinking of certain investment examples. For instance, right now, Mallinckrodt, which is an investment that I mentioned earlier during the themes, you know, distress themes that we're currently looking at. It's a company that sold a number of products, including opioids, and they got caught up in the opioid crisis in the US, and as a result, they went through bankruptcy. But there's a very complex plan of reorganization that they're, you know, at the tail end of negotiating and coming through bankruptcy court with right now. And there's some great opportunities to make money in this company. We've short sold their stock headed into it because there's a high likelihood that shareholders won't get anything. I think it takes a special expertise, you know, being a trained lawyer and having looked at these types of things for 20 plus years gives us an edge because you're in a federal bankruptcy court. You're looking at not just a bankruptcy restructuring, but one that's driven by litigation. And, you know, the litigation continues through to the end of the confirmation hearing. There's some claims that we think are, you know, very speculative, that some investors believe could break up the whole plan, but we have confidence that they won't. So having an opinion about these things, excuse me, that's different from, but well considered, but different from what the market might believe, I think gives us truly an edge in a market where, you know, everything seems to be becoming more efficient, and you know, when there's news, usually oftentimes the market has already figured it out. Well, I think true distressed securities investing and things like this are sort of one of the last remaining market inefficiencies. And so I like that complexity. I like things like that. I like things like, you know, the PG&E wildfire bankruptcy and all the uncertainty about that, you know, post confirmation, because it's a regulated company, which I think has an edge. You know, it will stand to benefit because they can securitize a lot of their CapEx requirements, and those liabilities, while large, are manageable. I mean, so having a view on these things, I think from a legal perspective, but also having a team that can help you assess those risks and help you think about them, I think is just a big advantage. I'm not sure if I fully answered the question, or if, you know, there was something else that you
No,
asked
you've
the tail
answered
end
that
of that.
and more.
Okay. Okay, well, thank you, Angela.
Yeah, absolutely. So, we are at the end of our presentation. On behalf of all of us at Schultz Asset Management, thank you so much for your time. We're so grateful for all of our partners and our investors who have been with us for, as in the words of Jeffrey, a quarter of a century. We are also excited to celebrate so many milestones together, including the launch of our second SPAC and continuing to grow together. Hopefully, we'll be able to see each other in person very soon. For more information on anything you've heard, please reach out to us at investorrelations@samco.net. I'm Angela Louie, and here are George Schultze and Jeffrey Glick. We wish you the very best in your investing, and we hope to see you in person soon. Bye-bye.